today we're going to focus on a key topic that we hear a lot about with our customers and prospects, which is standalone selling price. And we're going to talk a little bit about the concept and the importance of standalone selling price and show you some great intellectual property and methodologies that our team of experts have. And of course, today we're going to focus heavily on number 4, which is the core of the real activity that goes on here. Both 4 and 5 are the real core of the new activity that goes on and focus on step 4, which is allocation of the transaction price to the different performance obligations. And then, of course, we recognize the revenue. Julio, maybe you can comment for a moment of your thoughts on step 4, and then we'll kind of dive right into the next slide.
The critical part is, how do you allocate one transaction price to these multiple performance obligations? A simple example, you have a cell phone and you buy a warranty and you buy Netflix, but you're paying T-Mobile or AT&T $100 a month. So, in the background, us accountants, we really have to figure out what is the right methodology based on certain criteria to allocate that $100 over multiple performance obligations. So I think it gets very complicated for some companies, especially companies that have multiple element arrangements, and you really have to look at it very closely. We talked about it a little bit before, but it's part of step 4 in the 5-step process. And basically it requires companies to allocate the transaction price to each performance obligation in proportion to its standalone selling price. So standalone selling price is really what we used to call in the accounting world an arm's length transaction. So it's the price at which the entity would sell a promised good or service individually to a customer. Now we have to be very careful here because some people in the audience may say, well, what about intercompany pricing? Well, remember, SSP and ASC 606 only deals with external pricing outside of your company. So it does not include intercompany pricing. That's a whole different topic we can get into another time.
Prasad, you're as one of the leading practitioners out there, and you've been doing this now with us for 10 plus years. Do you see all of these used in many of the projects that you've been on?
Absolutely. Yeah, expected cost plus margin approach, residual approach, I have seen come across many clients using this.
Before we get in and actually show you how you can create a sales order and how it actually works, what we're going to do is we wanted to show you what the team has done, the table that they have built, the background that they have been utilizing with the tool. So looks like it might be loading. Okay, so this is going to be the table that you're able to actually come in and see those standalone selling prices. So what Prasad was talking about that inbound data and how it's bringing in the view of the invoices.